Welcome to Fuqua Faculty Conversations. I'm Cam Harvey. Some of you know me as the teacher of 350 Intro Finance, or my asset allocation course, or my corporate finance course that focused on emerging markets. And some of you are simply following me on my blog, gardenofecon.com. A few things to begin with. If you need to get through to me directly on Twitter, it's hash Fuqua alumni. If you're having technical problems, you can dial in the school at 919-660-7768. In addition, if you have to bail out, this is going to be posted so you could view later. So let me deal with first the basic idea of the session, and that is confronting global risks. In the pre-read or preview video, I talked a fair bit about some of the major risks that we face, and they're pretty known. So it's clear that there's a problem with the Eurozone. We know that there's great risk of something happening in Iran. We know that the U.S. is on a bad path right now in terms of its kind of fiscal house, and it's not clear there's going to be a remedy to that. And finally, the fourth thing that I mentioned is we know that there's some issues with our banks, even though most of them pass the stress tests. So let me kind of go briefly through these 4 points first, and then I just want to focus on the questions. We got piles of questions. So very briefly, and I will come back to each of these because there's questions on each of these. So very briefly, I will talk later about the Eurozone. My firm opinion is that the 1 trillion euros of LTROs in the 2 tranches that were put forward simply delay the day of reckoning. And it's a temporary fix. And it's amazing. It's like, I almost thought that the mission accomplished banner was going to be put up, and it wasn't quite. But that's basically how a lot of people are thinking, and it's just not the case. We're seeing it even this week in terms of what's happening in Spain. And I will talk about Spain. So this is just a massive risk. That's probably the one with the highest probability of something actually happening. So you've got these risks, and each of them is associated with a probability. So for that one, it's quite high in the short term that there's going to be a problem in terms of the Eurozone. And again, I will go through some very specific questions on the Eurozone. The situation with Iran is probably a story that has got less play, but it's the sort of unknown that could have a really devastating effect. It's got lower probability, in my opinion, than a breakdown in the Eurozone. So it's got lower probability because it's just so difficult to pull off. So some sort of military strike on multiple institutions that are tunneled into mountains, it's just very difficult to be successful, and it's really hard to even define what success is. So success in this point would be a delay. So I think that this is one that's got a lower probability, but if it's realized, could have a devastating impact in terms of a short-term disruption in terms of oil prices. So we're talking oil prices could easily go to $200 a barrel if there was severe disruption in the Gulf. And in that case, we're talking about confronting global risks. There's a case, if you're worried about that probability, and that is going to be devastating for your portfolio, that you could buy deep out of the money put options, really, or call options on oil. So, and at this point, those deep out of the money call options would not be that expensive, but as the risk increases, it's going to be very, very expensive. There's other ways to hedge that, obviously, in terms of taking long positions in energies and commodities, but the most direct way is with a deep out of the money option. I will talk about the U.S. debt situation later. We are on a bad path. We're basically seeing the future in real time in Europe. And that should be a great lesson to us. We see the dysfunctionality in countries like Greece, where they are just in terrible shape, even after this default. We don't want to be there. We are not Greece, obviously. We're a much stronger economy, but we can see a glimpse of what could happen if our debt gets further out of control. Again, I'm going to talk more about this when I deal with the questions. But right now, one thing I just want to seed is I was interviewed yesterday by Bloomberg about the Fed wanting to issue floating rate notes. And let me return to that because it's exactly the wrong strategy in terms of the risk that it imposes on the U.S. Economy. So let's defer that. But this is a very substantial risk. It is a risk that's more longer term in nature. So the euro risk is right in our face right now. Iran, we're not quite sure when that's going to occur, but if it does, it's devastating and the probability is lower. The U.S. is just on a bad path, and it could take years for a disaster scenario to be realized in the U.S. Last thing that I mentioned were the U.S. banks. And basically, the spin of the news was, to me, very discouraging, that basically only a handful of these banks failed to meet the 5% ratio, which, to me, the 5% is just too low. It doesn't make any sense. Effectively, it's like leverage of 20 to 1. I'm more of the opinion that we just can't afford as a nation to continually bail out our banking system. We can't afford these financial crises. So we need to be much more aggressive and take the core tier 1 ratios up very substantially. And indeed, if we did take them to 10%, which is about where I recommend plus another 5% contingent buffer, at 10%, there's really only three banks that pass. Okay, so even in Spain, they're holding their banks to 9%, yet our test holds the banks to 5%. Okay, again, we're in a stronger position right now, but we need to start preparing for the next crisis. We're still in a world crisis in terms of finance, so let's prepare now. And right now it's quite discouraging. In my opinion, the U.S. banking sector is still at risk. Again, it's much healthier than, let's say, in Spain, where essentially all of the banks are gone. And I'll talk more about Spain a little later. So there's no bank that I know of in Spain that I could say is solvent, even though that's not what most people think. Okay, well, let's get to the questions. And I've got a long stack of emails. And some of you send like 5 questions. I'm sorry, I can't deal with all of those questions. I'm going to have to cherry pick a few of them. Indeed, somebody sent 10 minutes before we went live a PDF 20-page document for me to comment on. I did not have time to read in those 10 minutes the document, so I really am sorry. Maybe I could do that at some other time. So let me go through, and what I'm going to do instead of reading all of the details of the question, because some of these questions, even though it might be one question, last a whole page. So what I'm going to do is to summarize some of the basic ideas. So the first question, sometimes I will say who they're from. The first one is actually from Jeremy Rogers, 2002 Daytime. And basically, Jeremy's question has to do with what should U.S. investors actually do, like institutional investors, even private investors. When you look at your portfolio, traditionally that portfolio was heavily biased to the U.S., but there is a trend to actually diversify that portfolio internationally. And that's been a very strong trend over the last 10 years. And I guess Jeremy's asking, should we kind of reconsider that trend? And let me try to answer that question. So I am obviously an advocate of diversification. And I don't believe that investing in any particular country is a wise move. You're basically taking a bet. And the bet, I guess, would be on the United States. So I am a believer in international diversification. It is true that with globalization, the benefit of diversification has decreased. And it's decreased for a couple of reasons. First is that even just buying the US portfolio, you're buying international presence, because the large US companies are doing a lot of business overseas. So you're getting even emerging market exposure, substantial emerging market exposure with your US portfolio. Is that enough? Probably not. So yes, you need to continue to look overseas. And it's kind of interesting the way I look at it, and Jeremy's question was maybe we should reduce exposure to Europe and emerging markets. Probably I'm also a great advocate of active investing. And it really depends on what the price is. So if it's the case that certain assets in Europe are overvalued, then of course you should reduce that risk. It's interesting to me that the relative riskiness of Europe versus emerging markets has dramatically changed. So it used to be the case that emerging markets were the riskiest thing out there for investing. And maybe they still are, but the gap between the emerging markets and the developed markets has decreased. So think of it this way. You think of the leverage of developed markets. So the debt divided by GDP is much greater than emerging markets. And then look at the growth of, in terms of GDP growth. Look at the growth of emerging markets versus developed markets. You know, Europe is basically going to have zero or negative growth next year. The US hopefully will be at trend, hopefully, but there's some uncertainty there. You know, Japan has been in the doghouse for 20 some odd years. So in terms of growth opportunities, you have to look offshore. Now that said, again, you need to look at the price, the value in terms of what you're investing in. Is it fully priced into the emerging market equity or the European equity? So again, you need not to make a geographic decision necessarily, but you need to make a value decision and be careful about the way that you do that. Let me just add one thing, and that has to do with value. I see a lot of practitioners looking at countries, and they present, you know, valuation ratios for countries like price to book or price to earnings, price to forward earnings, things like that, and argue, well, this country's cheap, this country's expensive compared to the US. And that analysis is foolhardy, in my opinion. And let me tell you why. It's not an apples to apples comparison, because different industries have different valuations, different growth opportunities. So the way to compare country A, let's say is the US, to country B, some other country, is to basically reconstruct the country's PE ratio based upon kind of the weights. So the weights of industries are identical. So look at the weights of, let's say, US industries and the US aggregate PE. And then use those weights and use the PEs in that other country to construct a PE ratio for the other country that's got the same weights for industries as the US does. Then you can make an aggregate comparison if you're doing country investing. So again, you need to go with value, and I would not retreat from international diversification, though tactically I think that there's a good reason to retreat on some of it. Okay, let's move to Vivek, who's 2006, it's got 5 questions. Unfortunately, I can't deal with all of these questions, but one question had to do with the preview video, where I was saying that there's certain things that you can invest in that have good insurance properties in terms of your portfolio. And in managed futures, I gave as an example, is something, and that's basically people that invest in many different futures contracts, and basically are long or short, essentially trend following or playing mean reversion. So a lot of it is quite momentum driven, and this particular type of investment presents a unique profile in that it's like a long volatility position. So when markets go down in general, these investments tend to do better. So it might not be positive, but certainly less negative. And they also do well when markets go up. So it's like a situation where you're kind of long volatility. Now, to get that sort of protection, you usually pay for it. And Vivek basically saying, well, gee, that doesn't make any sense because it seems to contradict finance theory. So and I think what that means is the theory of efficient markets. And I guess you've heard me say this many times, that the markets aren't efficient. So it's a question of how efficient they actually are. So these strategies have worked a long time. There's many reasons that momentum could work. Indeed, if you look at the commodity complex, which I'm pretty familiar with, 70% of investment in commodities is indexed. So people are basically trading with no information whatsoever. That's an extraordinary percentage compared to things like equities, which may be 25%, 20-25% indexed. So basically just the act of kind of moving into the market with some capital, there are people that are running momentum kind of programs can capitalize upon that. So there are some possibilities for some extra returns there. And essentially what you get is something that looks like insurance, and this is really important. This is not perfect insurance. You buy a put option. That's going to deliver no matter what. Okay? These types of investments have the right correlation properties, but they're not guaranteed. Okay? So it turns out there's no premium to pay, and indeed there is a positive premium. So it's not the only thing that you can do to protect your portfolio. And in the preview video, I talked about a number of different things. So investment in real assets is a possibility. That's often the fact of, increasing your cash is also possible in a period of heightened volatility. Options I don't recommend, and things like VIX, like going long volatility, just extremely expensive. Especially, if you're an institutional investor, you shouldn't be playing that game directly. If you're a retail investor, you might not have a choice. So an institutional investor has plenty of possibilities. So I did get a question from Lynn who asked, I talk about skew risk a lot in the preview video, and what exactly is that? And I apologize to my 453 students who have been thoroughly indoctrinated on this, but I've been pushing since 1999 this idea that we need to manage our portfolios in a different way. So we need to think not just of the volatility of the portfolio, but of the skew. And if you think of a distribution that is normal, it's got no skew, which means that the tails are symmetric. And what we don't want, or what we don't like, is a distribution with a big negative tail. So big negative observations, minus 50%, things like that. We don't want to be losing half our portfolio. So we actually like the positive skew but we don't like the negative skew. And it turns out that many assets, almost all assets, are not normally distributed. So we need to manage that skew, and people just plain don't do it. And the risk management tools are often very naive in terms of the way that they actually manage the skew. So if you're faced with a couple of assets, they might have the same projected returns, the same volatility, but different skew. Well, you prefer the asset that's got the positive skew. So I'm very much an advocate of being aggressive in terms of managing that skew. So, look at things beyond volatility. Often people are investing and looking at things like Sharpe ratios, which are the expected returns or the historical returns divided by the historical standard deviation. Okay, that to me doesn't make a lot of sense. And I think I said this in the preview video. If you look at like hedge fund classes, you see like relative value with a Sharpe ratio of like 2.5. And then you see managed futures 0.75. So, oh, well, I'm going to invest in relative value. Well, not so quickly, please. What about the skew? And it turns out the skew for relative value is massively negative. And I like that. And the skew for managed futures is positive. And I like that. So you just can't look at the return divided by the volatility. I want to know about that downside, and I want to manage it directly in my portfolio. Okay, so this is kind of a theme of what we're talking about today, and that's not just recognizing what these risks are, but having a framework, a portfolio framework to manage this directly. And I don't care who you are, with perhaps one exception, and I'll talk about that. So, often institutional investors are long-term investors, and basically their idea is, given that they've got such a long horizon, they can ride out a lot of these short-term problems. So effectively, they can sell volatility, so they could sell protection. And indeed, that's been the strategy of a lot of these long-term endowments, institutional investors, until the crisis hit. And all of a sudden, oh, gee, we dropped 30%, and we're supposed to be paying out a certain amount. What are we going to do? So they did not manage the tail. So the people that were traditionally selling volatility all of a sudden realize, gee, I've got this negative tail, and maybe that's the reason that I've earned extra returns. So think of it as selling insurance. You sell insurance to somebody, you collect the premium. And the mistake that a lot of people made was to consider that premium alpha. If I sell an option, I collect a premium. That's not alpha. It's just a compensation because you're taking a negative skew risk. If the negative scenario happens, you have to pay out. Right? The fire happens, you need to rebuild the house and pay for it. So this is something that is really crucially important. A lot of people during the crisis got caught because they were sold products that were essentially selling options. So, and their return was something plus the so-called alpha, which was no more than the correct compensation for bearing negative skew risk. The reason this happened is that people weren't thinking like that. People were thinking, oh, well, this investor has got a better Sharpe ratio than somebody else. Well, maybe the reason that the Sharpe ratio was better was because they were taking this negative skew risk. Okay, so this is really, I think, crucially important. As I said, we need to have a risk management framework that weighs this downside risk as carefully as we look at volatility risk. And just by the way, if you invest in, let's say, U.S. equity, that's got negative skew. Okay, and it's obvious, right? You look at the financial crisis, what happened? Negative 50% at some point. Okay, so what we need to be doing is, when I said diversifying our portfolio, okay, what we need to be doing also is to moving that skew to something that's more tolerable for us. Okay, so I answered, I guess, a couple of questions. Let me, this is a good one. Actually, a lot of people don't know this one. This is from Rod Schultz from '89. And he asked about another risk that I had actually not put on my list, and actually didn't put it on for a reason. But he asked about Texas actually breaking away from the U.S. And as I think most people know that Texas got the option. So when they joined the Union, they were independent for 9 years as a separate republic. But when they joined, they had the option of actually doing two things. And Rod, you addressed only one of them, but there's two things that they can do. One thing is to leave, and that would be a substantial hit to the U.S. if they left. And the other thing, they've got the option to break up into 5 separate states. I mean, it's kind of interesting. You think about how that would affect what goes on in the Senate. So going from 1 state to 5 states. So is this likely? No. And even though maybe 20% of the Texans favor breaking off from the U.S., but what are the sort of things that might change the game? And what I'd like to do is to bring Europe in, because it's kind of a similar situation with Germany. Okay, so Texas is blessed to have good natural resources, productive economy, low unemployment. And you can imagine a situation where the U.S. continues on the path that it's going, and basically has to do a massive monetization or state-by-state bailout. And you can imagine at some point Texans saying, you know, we don't want to do that. It's just too expensive. It's actually maybe better if we're on our own. Do I think it's that likely? Probably not. And the reason is that we do have a complete fiscal and monetary union. But across in Europe, it's a much different story. Okay, because in Europe, we've got 17 countries with a monetary union, but not a fiscal union. And Germany is being continually asked to bail out. And there just basically isn't enough money right now on the table to do that. Okay, so there is a real possibility of either, you know, people talk about, well, is Greece going to leave? You know, probably. It might be a good example to set for the Eurozone. But when I look at the numbers, I just can't see where the money is going to come from to deal with Spain and potentially with Italy. The funding needs in Spain are enormous. They're basically well over €1 trillion next year, or this year, 2012. So the ESM, the pool of money that's been set up, will come online fairly soon. That's 500 billion euros. Is not enough to cover Spain. You know, the Spanish banks were very aggressive during the LTROs. They borrowed from the ECB at 1%. They used that money to buy Spanish government bonds. Okay, that helped the Spanish government bonds in the short term, but very soon thereafter, essentially, you know, 5 weeks after, we see the yields going back up again. So essentially, we're in a situation where the banking system in Spain is frozen. The credit is frozen. People are having a lot of trouble getting loans. You really can't use sovereign debt as collateral. The interbank market it's effectively stopped, and the ECB is basically substituting for the interbank market. You see massive imbalances, and I talk about this in my blog, in the Garden of Econ, the so-called, you look up what I've written on Target 2. There are just massive imbalances right now. If you look at the periphery and look at Germany. So Germany, through the back door of the ECB, they're taking basically IOUs from the ECB, over 500 billion euros of IOUs. And basically, where's that going? It's going directly to the periphery. So Germany has put in a lot, you know, in terms of the stability funds. They put through the back door in accepting all of this ECB IOU. At some point, they're going to have to basically draw the line. You hear they're committed to the euro, but you hear the politicians speak with forked tongue so many times. Well, we'll never let Greece default. How many times do we hear that? And then they defaulted. So I think, you know, the kind of the similarity between the Texas question and Germany is that at some point it might be enough is enough. And that could be a situation where there become two currency blocks. It could be Germany just leaving. You know, these are not highly probable scenarios, but these are realistic scenarios that you need to plan for. Germany doesn't want to leave the euro because they know what happens if they go back to the Deutschmark. Their currency would double in value, and it'd be devastating for their export industry, which is a huge part of their economy, right? So I estimate they would lose half the exports. Now, in terms of the total money coming in, it would be about the same, but it would just be so disruptive for the economy, for unemployment. And Germans really don't like inflation, but they also don't like unemployment. So I think we'll try to keep it together, but there's a substantial risk. Okay, well, let me go to kind of a related question from Louisa, 2001. And yes, I do remember your project on art and asset allocation, fine art. Actually, I've been asked a lot for that project. So basically, Louisa is asking whether we're moving to a sort of scenario where people have to decide what they want in terms of a national policy, national industrial policy. So what I mean by that is, do you want the cheapest possible goods, which would mean outsourcing production to countries that have wage rates, you know, 1/50th of the U.S.? Or do we want to essentially protect our industries and pay a higher price, but have more stability in terms of our own economy? And it's a really good question. And essentially what this question has to do with is what will be the future trend of globalization? So we have had this trend that's just been enormous in terms of opening up markets, a huge part of economies basically dependent upon things that they don't have control over, other countries. So is it possible that there will be a retrenchment? And I think it's an intriguing idea. And indeed, in Europe, you're seeing that already. So even within the Eurozone, effectively, it's so difficult to deal across the Eurozone in terms of interbank deals that people are looking within their own country. So effectively, once you agree to trade and to open your economy, then this leads to higher revenues, higher GDP per capita. You know, it's basic economic theory that it's a good thing for those sorts of things. But what about the risk? Okay, and how do we think about the risk? Well, the risk is potentially disrupting, you know, large sectors of your economy. Potentially your whole economy isn't competitive, or a large part of the economy. You all of a sudden inject the risk that your well-being is subject to something that happens overseas. Okay, so I think that people are basically having second thoughts about, hey, where does this lead us? Basically, we lose our sovereignty at some point. And is that what you want? So I think that a lot of policymakers have been looked at all the positives of globalization. And certainly, I've done a lot of research that shows some of the benefits of globalization in terms of extra GDP per capita. That's true, but there is a trade-off here. Okay, so do you want control of your own destiny or not? Now, certain countries have no choice. They have to trade. Other countries have a choice, and the U.S. is a great example. It's a large country, and even if you think of a kind of a block of countries, Canada, the U.S., Mexico, they're self-sufficient, literally. So they, if it was in their interest, could effectively block off trade. I'm not saying that's going to happen, but I think that policymakers need to think through the risk that's introduced. Do I think globalization is going to continue on its trend? No. Actually, I think it's going to reverse for a while and then effectively level off. So people will take a level of risk that they are comfortable with. Okay, so I've got a question from Mario in 2003 daytime. Actually, a bunch of questions. One of them has to do with Japan. And let me just briefly touch on Japan because I've got a number of Japan questions. So Japan has been in recession basically since 1990. And it's a strange recession because you go over there and it doesn't appear to be a recession, and unemployment is low, but there's really no growth. And the demographics are not very good in terms of the future. They've got huge debt, like huge debt compared to GDP if you look relative to other countries. But there's a huge difference. And that is that the debt in Japan is owned by the Japanese. So very little of their debt is overseas. It gives them huge flexibility in terms of what they do. So think of it as you've got debt within your family. So they basically can go on playing this game, and if they have to expropriate, it's from their own people. And it's not going to cause the disruptions that you would usually have in terms of exchange rate and things like that. They've been in zero interest rates for a very long time. They took a bad strategy in the 1990s, and that was that all of their banks were zombie. And effectively what they did is they didn't consolidate, didn't create bad banks and kind of strengthen their bank, but just kept them going. And what they did is they channeled whatever lending to large corporations, often that sat on the boards of these large banks. And the small companies, they didn't get the capital, didn't get the loans. So, and where does growth come from? Growth comes from small companies. So they put themselves on this really bad path of low growth. Now, amazingly enough, given everything that we know about Japan, and given the chairman of the Federal Reserve is an expert on Japan, we basically followed their playbook in the financial crisis. What do? We bail out everybody, even though we know some of these banks are effectively zombie. The banks basically cut off credit to small and medium-sized business and focus on the large corporations, which we know are not creating jobs. Actually, they're actually reducing employment. So that doesn't make any sense. That's not a recipe for growth. Okay, it's even true today with our Duke CFO Magazine survey. We asked the small and medium-sized businesses about the credit conditions, and they really haven't improved that much for a lot of firms. So it is just, in my opinion, a disastrous strategy to cut off credit to your growth industries. We talk about what we really need is growth. And, I agree. Our unemployment situation, which I'll talk about in a second, is not good. So we need growth. And that doesn't mean hiring people temporarily to build, a bridge. Okay, we want real jobs. So we need growth for that to occur. And we don't have that. And when the strategy of the government is basically to focus on, bailing out everybody, and then those banks want, even though they're bailed out, they want to reduce their risk. They consider anybody who's small risky. So they're not willing to go ahead with loans to many small and medium-sized businesses. Then you're not going to get growth. Okay, so the financial system is really important here. So indeed, we have taken multiple pages out of the Japanese playbook, unfortunately. And what that means is just lower growth. Now, let me also make an important caveat here. The U.S. is in very good shape relative to the rest of the world, because it is still the case that the U.S. is the best place in the world for innovation. And that innovation comes from small and medium-sized businesses. And California is a great example of what can happen there. 12 people, Instagram, $1 billion. 2010, Stanford grads. Okay, so there is still the best, most productive innovation coming from the U.S. That's what we need. We want growth. That's what we need to focus on. We need to make sure that everything is done that is possible. I'm not talking about subsidizing, but my example with the banks, make sure that the banks aren't shutting out small business and focusing just on large business. We're effectively the owner of these banks. So I think also we absolutely have to give our banks different orders in terms of their risk ratios. And people will say, well, if we do that, then it's going to cut off credit. But it's just not the case. It's absolutely not the case. So other banks can come in, and we've seen actually, it's very interesting, that to me, one of the most disruptive technologies for finance in the future will be an alternative to banks. Crowdfunding. So forget the bank. Just go with the ultimate democratic way of raising money. You don't have to deal with them. Now, we've seen this at the infancy. I'm very excited about it. This could be something very important in the future that could marginalize banks and change the way, indeed, that the role that equity plays. Also, private equity as well as public equity. Okay, so there's also a question about the stability of the global banking system. Are we better off now than we were, at the beginning of the financial crisis? The answer is no. It's like, to me, it's still a very risky situation in the U.S. As I said at the very beginning, we are faced with banks that are just over-leveraged. You want to reduce the probability of a financial crisis? It's easy, just decrease the leverage. The banks in Europe, 40 times. And then that capital is even questionable. Right? In Spain, I keep on talking about Spain because it is the biggest risk factor on the screen right now. Spanish real estate has gone down by only 10% in value. 10%. And what do you think a reasonable number is? Like 40, 50, something like that? Yet it's been carried on the books of the banks at unrealistic values. And when you mark to market, those banks are gone. Okay. Again, the U.S. is in a better position right now because real estate has gone down in value, and banks have taken big write-downs. But I want to prepare for the next crisis. So we know there's going to be a next crisis. So let's prepare for it. Let's reduce the leverage of the banks. A question from Lee from 1983 about the Eurozone crisis being contained. And to me, and if you follow my blog, it was almost laughable with the second LTRO. Oh, what a great idea. And basically that was the talk. That was the spin in the press. You know, we've done the job. This is exactly, we've massively monetized. And yes, they have massively monetized, right? So the ECB balance sheet compared to the GDP of the Eurozone is much larger than the Fed's at the height of the financial crisis in the US. So there's big monetization going on. But it's not enough. It doesn't address the fundamental issues. The fundamental imbalances are still happening. And it basically is a short-term fix. People thought, well, maybe this will be good for quite a while. They were thinking of maybe a year, but now it looks like a little over a month, and we're back at it. So something will happen, and this is a very temporary containment. I've got a question from Anjo from 2002 about kind of how do we think about fixed income, U.S. fixed income in particular. And there I want to kind of circle back to my interview with Bloomberg about floating rate notes. I gave testimony to Congress in 1993 advocating shifting a lot of the U.S. debt to floating rate notes in 1993. And that was, I think, the reason that I got the phone call from Bloomberg. And basically, well, you've advocated floating rate notes, and now the Treasury is thinking of doing this. And I said, well, oh, hold on a second, please. I advocated floating rate notes in 1993 when interest rates were close to 8%. And it made a lot of sense to me to shift some of the debt to floating rate notes to take advantage of declining interest rates. And indeed, if the Fed and the Treasury had done that, there would have been dramatic savings. Because if you look at interest rates from 1993 to 2012, it's almost straight down. Now you're at a point where the 10-year bond is 2%. And you want floating rate notes? Sorry, that's absolutely the wrong thing to do. And the reason is that it puts the government, puts the economy at huge risk. And let me think of it in the following sense. The size of the federal debt has exploded over the last 5 years. So we've added about $5 trillion. And 2012 is going to add probably another trillion. Yet, if you look at the servicing cost of the debt, it's about the same or even less. And the reason is that interest rates have gone down so much. Okay, so when the rates are 2%, what I would advocate now is forget the floating rate notes. You need to lock in and lock in as long-term as possible at these cheap rates. Okay, think of this. If you went floating rate and the rates, let's say, are 2% right now, it is not inconceivable, given the size of the Fed's balance sheet, given the economy picking up a little bit and the velocity of money picking up, it's not inconceivable that the rates go to 4%. And 4% is even low. So that would be devastating in terms of the amount of money that the federal government has to pay out to service. You know, it would mean massive cuts in other programs, or just increasing the federal debt even more. So that's not the strategy we want. We want to lock in. Indeed, we want to go as far out as possible to effectively lock in these low rates, give us some time to put our house in order. So no to floating rates. It doesn't make, the case is extraordinary. People say, well, some investors want to buy floating rates. Well, yeah, no kidding. Like, who wants to buy long-term Treasury debt right now at 2%? Who wants to lock in 2% for 10 years when you know the probability? Yeah, so yeah, investors want the floating rate notes, and indeed they can get them with a swap. It's pretty straightforward to do. So for the Treasury to be doing this, I don't think makes much sense. Let me. I get a question that's interesting. What do I read to keep current? So let me tell you. And this is, I'm not paid by anybody to do this. I do read some proprietary publications from some hedge funds, which are not available to the public. But the general thing that I read, Wall Street Journal, Financial Times more than Wall Street Journal, and in particular the Alphaville within Financial Times, very good. And there's actually a room you can get into called the Long Room. You have to be qualified to get into it, but very good information. I get a subscription to ISI, which is very good. It's a daily service. It's expensive, really expensive, but it's very high quality macro. GavCal, I get also subscription, and it's extremely high quality, especially for China and questions like that. And I get a number of broker stuff like Goldman and Credit Suisse and things like that. But that's a fair bit of reading every day just to keep current. Let me go to the next question. And what about the value of the euro? Why doesn't it depreciate? Well, what you have to do, the first thing is, why is it 1.3 and not 1? Well, it has to do with the relative amount of money that's out there. So if it would be like 13 if we had 10 times as much currency out there. So, but why hasn't it depreciated more? Well, I think the reason is that there are some strong economies, in particular Germany, within the bloc, and essentially Germany is holding the fort right now. Germany has greatly benefited from cheap currency. So most people don't realize that the trade surplus that Germany's been running compared to its GDP is greater than China. Okay, so China gets all the criticism for, well, you should let your currency appreciate. Well, Germany has benefited from a cheap euro, effectively. You know, if it was floating, that there would be huge appreciation, like if Germany had their own currency. So they have basically, the euro has subsidized their export sector. Now it's coming back to bite them. Has it been worth it? I'm not sure, because we haven't seen the worst of it yet. You know, we've had these Band-Aids. Hasn't really cost the Germans that much, but gee, it's going to be costly once to get out of this. There's a question from Andy from Wemba95 about trading basically over the counter and versus on exchanges and Dodd-Frank, a number of questions having to do with the riskiness. And I think it's extremely interesting that with the Dodd-Frank, there's a lot of move to centralize trading, exchange-based trading, get rid of the OTC when possible. But it is ironic that you have something like MF Global. That's not OTC. That's just like regular exchange-traded stuff. And they go down, and it's a huge hit to the market. So it's not just exchange trading versus OTC. And some of this regulatory noise is going to be very costly for the US. That stuff is just going to move offshore. I guarantee it. And it's happened before. So the point is not where it's traded, but the risk management and the controls that go on while it actually is. And there is just no doubt that we need more effective risk management both within corporations and from our policymakers. That doesn't mean more regulation. It means regulation that makes sense, that looks at all of the dimensions of risk, not the Sharpe ratio or something like that. We need to look at all of the possible risks. And right now, it's the sort of job that we're doing is not very impressive given what's at risk. And what's at risk? A lot of people. So people, meaning unemployment. And obviously unemployment is going to be a major issue in the election. I believe that a mistake was made, and this is not a Democratic or a Republican sort of view. I think basically almost everybody shared the view at the time, well, with some exceptions like me, that what happened during the financial crisis and the unemployment rate going up was a cyclical thing. That was like a recession. And then you get some unemployment, and then it comes back down to normal. That's not what's happened, because it wasn't cyclical, it was structural. When you had a sector fueled by negative interest rates, the housing sector, and a large number of people working in that sector and refinancing their mortgages, taking out money and spending, basically creating a lot of jobs, and then all of a sudden, poof, they're gone. 5 million jobs still lost. Okay? A lot of those jobs are just not going to come back. The housing, we see, oh, housing's bottomed out, it's bottomed out at a third of what it was. Okay, so 8.2% unemployment, oh, well, that's good. It's been going down. 200,000 jobs in the first 3 months. Well, that's good. Anything over 100,000 is good. But we need to be very careful the way we look at this. And the way that I look at it is the following. Look at the participation rate. So the people participating in the labor force in December 2007. And that is the start of the recession, December 2007. It was 66%. Today, that participation is 63.6%. Okay, so fewer people are participating. Effectively, some people are just basically dropped out of the labor force, either discouraged or just basically gone. So what about this thought experiment? What about taking the participation rate in 2007 and putting it to today's numbers? And to do that, our population's actually grown. So we apply the 66% rate, and what you get is an unemployment rate today of 11.2%. Not 8.2%, 11.2%. Okay, so we actually are short, by my calculation, 6 million jobs, because people have come into the labor force. Some people say, well, yeah, we're dropped, 5. We need 5 to get back to where we were. Well, people joined the labor force the last 5 years. So we are a long way off. And that is the cost of these financial crises. So this, monetary policy that didn't make any sense beforehand, where you think that you can manipulate the economy by basically putting interest rates to 0 or negative. Indeed, that's what you got right now. You've got effectively a negative interest rates. Again, when I said who wants to buy a 10-year bond at 2%, well, the return in real terms is 0 or negative. So when you have these types of interventions to the market that disrupt the market, you're asking for trouble. And we got into this trouble, and effectively by not doing risk management properly. So the theme of kind of what I'm saying today is that we, as individual investors, need to look beyond the usual portfolio metrics that we thought of. If we think risk is increasing, then we need to deal with it. Indeed, if you look at the options on the S&P 500 right now, the Skew, check it out. There is implied today a probability of a downside move of 2 standard deviations is 12 times more likely than a 2 standard deviation move up. Okay, that is risk. You need to take that into account in your portfolio. Institutional investors need to take that into account into their portfolio, and our policymakers need to open their eyes to see. And actually, you don't need to look to the future, you need to look to Europe. It is right there. Your future is right there. So you need to do something about it right now. That means risk management, plan for the future. And right now, the tools we have are very crude. The will that we have in terms of government is very weak right now. I hope that we don't need another crisis to spark some innovation coming from our government. Let me finish off Thank you for putting up with me. I didn't get to a lot of the questions. I'm sorry. Maybe we can do this again. We've got another faculty conversation coming up in June with Professor Bell, and I hope that you tune in to that one, and you'll get an email about it. And I'm really glad I could have done this, to reconnect with so many people, getting emails and questions and updates from you. It's been good. And we will post this, as I said, for other people to view. So thank you.